Be Wealthy and Smart, episode 613.
I'm gonna live the rich life, full and best life. So if y'all know what I mean, put your hands up and declare with me. Yeah, I'm full of it. I'm gonna live the good life, beautiful and glorious life.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about why are the rich spending less? As you know, I like to track what the wealthy are doing, how the rich are spending. These things can be important trends and show us what's happening in the economy. These trends can be important indicators of possible slowdown or a speed up in the economy, and we just like to track and see what's going on out there. As you know, recently I was over at Jackson Hole visiting some friends and I was on vacation and had a fabulous time. And as I always do, when I'm on vacation, I always look at the real estate market, whether it's just grabbing a brochure at a real estate office or getting online and looking at listings, or maybe running into an agent somewhere asking some questions, or even potentially going into an open house. It's just something I really like to do. So while I was in Jackson Hole, I did look at the real estate market there. And what I noticed was there were a lot of high-end homes for sale. There were homes in the $3 million, $5 million, $9 million range that were on the market and had been on the market for, in many cases, over a year and had not sold. I also looked at some high-end markets in other ski areas like Aspen and some other high-end resorts and found a similar trend happening. Well, recently I was on Zillow.com, and I was looking at coastal real estate in California, mostly Southern California, from around Newport Beach, Laguna Beach, San Diego, La Jolla, kind of everything within there, just for fun. I just really enjoy doing it. And by the way, we should all be looking at things no matter what the price is, whether you can afford to buy it or not. It's a great idea just to look at things. It's a way of telling your mind that you can have anything that you want. So it's a good mindset drill for you to do these kinds of things. But nonetheless, I was looking at these outrageously priced properties in Los Angeles. I mean, crazy prices. $55 million, $100 million. It is really insane, some of the prices of the homes that are for sale in Los Angeles. And I started thinking, what if these homes don't sell? What if we have already seen the peak of the real estate market? Because I've been reporting to you how the luxury market has declined sharply over the last few years. What if those homes don't sell and they go back to the bank? Because a lot of those developers do take bank loans and don't use their own cash in their development projects. So what if the bank takes them back, they go through foreclosure, and the bank tries to sell them and no one buys them again? Maybe no one wants a 35,000 square foot house. I know I don't, even if it came down to affordability level. So maybe these things in the future, maybe they'll be turned into condos where they could become more affordable for people. Maybe that's going to be the solution, but there's going to be some mega houses out there that aren't going to sell, are going to go back to the bank, are going to try to be sold in foreclosure and still won't sell. So I'm just saying we're going to see some interesting trends maybe in the next 3 to 5 years. But I think that there is going to be an issue with some of these huge houses that got into the market too late. The buyers aren't there from overseas like they were. The Russians, the Chinese aren't buying like they were. And the real estate market isn't skyrocketing in certain cities like it was. In fact, prices have been declining. If you watch one of my favorite shows, Million Dollar Listing New York, you hear them lament every week about the real estate market in New York. and how prices are declining, homes aren't selling, they're sitting on the market longer, especially the high-end luxury market. And why is that? Well, as I reported in an earlier podcast, it's because the tax laws changed, and that made a huge impact, in my opinion. So what happened? The tax deduction for state taxes was capped at $10,000, and mortgage interest deductions were lowered from $1 million in interest that's deductible to $750,000 in interest that's deductible. This affected people mainly in California, New Jersey, New York. We're seeing it in some other states that have high state income tax as well. But I think it's a major trend into why the rich are spending less and why there are so many 10, 15, $20 million homes on the market in Southern California. It was mind-boggling to see literally the dozens and dozens and dozens of these high-priced homes, waterfront homes, beach cliff homes, beachfront homes, just sitting on the market with a very high price tag. And in many cases, having been on the market over a year or longer, people just aren't lowering their prices. And that's a huge mistake because I really think, where are those buyers going to come from that are going to pay those high prices? So we'll see. We'll see how it all turns out. But I am not thinking that this high-end real estate situation is going to be very good in states that have high state income taxes. But I want to share an article with you from CNBC written by Robert Frank. And in this case, he's saying it's a new recession warning. But you know my opinion that I don't see a recession on the horizon at this time. I think perhaps after the election, we may see a recession, which is more normal in the presidential election cycle. But normally during that presidential election cycle, we see the third and fourth year of the election cycle be the best years in the economy. Of course, right now we're in the third year going into the fourth year, which would be 2020. And I think we're going to then see some issues creep up from 2021 to 2022, which are usually the weakest part of the presidential election cycle. So I'm not seeing a recession right now, but I am seeing some problems in these high-end real estate markets in high state income tax states. But let's take a look at this article. So Robert says, a sudden pullback in spending among the wealthy could cascade down to the rest of the economy and create a further drag on growth. These are bullet points, by the way. His second bullet point is high-end real estate is having its worst year since the financial crisis. Third bullet point, luxury retailers are struggling while discounters like Walmart and Target thrive. Fourth bullet point, at this month's massive Pebble Beach car auctions, the most expensive cars faltered on the block. And fifth bullet point, in the first half of 2019, art auction sales were down for the first time in years. And here's what he has to say. The rich have cut their spending on everything from homes to jewelry, sparking fears of a trickle-down recession that starts at the top. From real estate and retail stores to classic cars and art, the weakest segment of the American economy right now is the very top. While the middle class and broader consumer sections continue to spend, economists say the sudden pullback among the wealthy could cascade down to the rest of the economy and create a further drag on growth. Luxury real estate is having its worst year since the financial crisis, with pricey markets like Manhattan seeing 6 straight quarters of sales declines. According to Redfin, sales of homes priced at $1.5 million or more fell 5% in the U.S. in the second quarter. Unsold mansions and penthouses are piling up across the country, especially in ritzy resort towns, with a nearly 3-year supply of luxury listings in Aspen, Colorado, and the Hamptons in New York. Retailers to the 1% are faring the worst, with famed Barney's filing for bankruptcy and Nordstrom posting 3 consecutive quarterly declines in revenue. Meanwhile, Walmart and Target, which cater to the everyday consumer, are reporting stronger than expected traffic and growth. I just want to pause there and say, The consumer is 2/3 of the economy. And so it's not all about the top 1%. We do like to follow their trends because, especially in luxury real estate, other real estate tends to follow luxury real estate, but not everything does. Because maybe the average person isn't out there buying jewelry and art. So if the 1% slows down in that area, well, that's just what happens. It doesn't mean that it's going to pull down the rest of the economy. But the consumer is 2/3 of the economy. So as long as we see the middle class continue to be spending and have jobs and income coming in, discretionary money to spend, I think we're okay in the recession area. The article goes on to say, at this month's massive Pebble Beach car auctions, known for smashing price records, the most expensive cars faltered on the auction block. Less than half of the cars offered for $1 million or more were able to sell, but cars priced at under $75,000 sold quickly, many for far more than their estimates. In the first half of 2019, art auction sales were down for the first time in years. Sales at Sotheby's dropped 10%, and Christie's auction sales were down 22% from a year ago. There are many reasons for spending declines. Tax changes, for instance, are to blame for some of the real estate slump. And parts of the high-end economy have retained their shine, from luxury new car sales to Swiss watches and fashion. Yet recent data suggests the U.S. wealthy are beginning to shut their wallets. If their spending falls further, the broader economy could start to feel the pain. The top 10% of earners account for nearly half of all consumer outlays, according to Mark Zandi, chief economist at Moody's Analytics. But their spending has fallen over the past 2 years, while spending for the middle class has accelerated. If high-income consumers pull back any further on their spending, it will be a significant threat to the economic expansion, Zandi said. The savings of the rich has also exploded, more than doubling over the past 2 years, suggesting that the wealthy are hoarding cash. The middle earners, or those in the 40% to 89.9% of the income distribution, have largely picked up the spending slack from the rich. If job growth slows any further, unemployment will begin to rise. The middle earners will pack it in, resulting in an economic downturn, Zandi said. There are 2 main reasons for the wealth slump: volatile markets and slowing global growth. The top 10% own over 80% of stocks in the United States, so they are far more sensitive to the recent swings in stocks and bonds. Also, because many of the wealthy also own companies that do business overseas or have foreign exposure, they have become an early warning system for the economic storms forming around the world. The middle-class consumer, however, is being buoyed up by strong employment and a relatively stable housing market. A U.S. economy that for over a decade has been defined by the rich reaping the gains and fueling the spending has now flipped. Now it's Main Street that is prospering, while the investor class is signaling a consumer recession. The rich still have plenty of wealth to spend, but spending at the top is driven by confidence and certainty, and right now they are finding little of either in the global stock markets and trade war. End of article. Well, again, I'm going to politely disagree with his assessment that the rich are controlling the economy. I really don't believe that. I think it's mostly the middle class. And I think as long as the middle class is employed and making money and spending, I think the economy will hold up. I do, however, think that there is a lot of high-end real estate with these big price tags that is going to have to be dealt with at some point. And I don't know who is going to step in to buy such expensive homes at these outrageous prices. These are north of $3,000 a square foot, and a lot of them are dated, and people aren't going to want to pay that kind of a price for something that's dated, and they may also feel like this might be a short-term top in the market, at least in the luxury market. So they may be reluctant to buy into a market that's been declining rather than a market that is rapidly appreciating. Just my 2 cents on the subject, but I really, again, see that the economy is looking strong. All of our indicators are looking very good. I just think this luxury housing market is something we're going to be keeping an eye on. I'll be reporting back to you on, because there are some big changes that have to happen in order for real value to be reestablished in that high-end luxury market. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be updated as soon as new podcasts are available. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.
As always, I will post the article in the show notes so you can take a look at the article. And don't forget, all 613 of my podcasts are over on my website at lindapjones.com/podcasts.